Hello, this is Elizabeth Pluswick, and today's video is about cost behavior. So how do costs change, and why should you as an engineer even care? Part of your, and we'll go through that and do some calculations on fixed costing and variable costing, and a little bit more on the income statement in this video today. So why do costs change, or how do they change? Well, you as an engineer are proposing solutions to clients. Sometimes those solutions include buying a new machine or some kind of asset, and that will result in depreciation of that asset. And so that's additional cost to the company, right? So what kind of cost is that, and how is it going to change the company's financial situation? That machine may also be used to run parts and produce revenue when those parts are sold. And so that's another cash inflow. That machine also may have operating expenses, maybe additional labor or maintenance on that machine. So those are expenses that will hit the company's income statement and affect the company from a financial perspective because of your design recommendation to buy that new machine. All right, so that gives a little bit background on why you should care. Let's quickly look again at what is an income statement. The format of an income statement for a company is sales revenue. That's when goods or services are sold and customers pay for them. That results in sales revenue to the company. And then we have all kinds of expenses here. So expenses for rent, labor, supplies, and then we've already talked about depreciation expense and getting down to computing net income for the business for that 1 year. Now these three, rent, labor, and supplies, are all cash expenses. And we know from the last video that depreciation is a non-cash expense, right? We also know that we have to take that into account in computing income tax correctly. That was the last video. I didn't compute income tax on this, but since the company is profitable, they will have to pay tax to the IRS and the State Department of Revenue, pay corporate income tax on that income. So that's why we had to depreciate an asset and compute tax, and that was in the last video. But what we want to focus in on today is these expenses. What are they, and how do they change with production? If production goes up, are these expenses going to change or not? So we've got a couple different categories of costs here. And the first one is called variable costs. And variable costs do change in total as production changes. They're directly related to production. So if production goes up, total variable costs will also go up. If production goes down, total variable costs will also go down. Okay? Variable costs remain the same per unit of item produced. All right, so think about that a little bit more. Variable costs have a direct correlation with production. I already said that. And some examples are direct materials, direct labor, and supplies. For instance, if you're building bicycles, one of the components of direct materials would be the bicycle tires. If you make one bicycle, you need 2 tires. If you make 10 bicycles, you need 20 tires. So the total cost to your company for tires will go up. It's variable. It increases in total as production goes up. But each tire by itself, the cost of each tire remains the same, no matter what happens to production. Now you say, well, what about bulk discounts? What about shipping and freight? Yeah, there's a little bit of variation with shipping and freight and bulk discounts, but the general rule is that variable costs remain the same per unit, but that they change in direct proportion with production levels. So the total variable costs go up as production goes up. Okay, so examples: direct material, direct labor, and supplies, they're all variable in nature. The other kind of expense we have is called a fixed cost or fixed expense. And the definition of a fixed cost is it stays the same for a period of time. We call that period of time the relevant range. Generally, relevant range is 1 year, and the boundaries of some level of activity. You know, say production, our plant can produce between 0 and $100,000. I'm sorry, 100,000 units. And if we produce more than 100,000 units, we're going to need another factory. So the relevant range is some bounds of production level and some bounds of time, usually 1 year. Fixed costs stay the same for that relevant range. The next year, the fixed cost might be different, but for that period of time, it stays the same. So examples of fixed costs are straight line depreciation, right? Stays the same per year. It's based on the asset cost. Rational allocation of that cost over time. So it's fixed for the year. Anything that has to do with the word salary is going to be a fixed cost. Rent, anything to do with contracted expenses. They're set for the year by contract. They're not going to change. Okay, those are fixed costs. So fixed costs have an inverse proportion with activity when you're talking per unit. So per year in total, fixed costs remain the same, but per unit, they will change in direct inverse proportion with activity. For example, say rent. Rent is a fixed cost. It's set by contract, right, by a lease for $12,000 per year. So it's going to stay the same for 1 whole year. If the company also produces 12,000 units of product during that same year, you just divide cost divided by production, and you would get each unit absorbs $1 of cost for rent. Each unit has to take on cost of $1 in order to cover that rent. If production levels go down to 1,000 units, used to be 12,000 units a year, if production goes down to just 1,000, each unit now, instead of having to absorb $1 cost, it goes up to $12 of rental cost. Rent, 12,000. If we only produce 1,000 units, each unit has to absorb $12 of rental cost. So you can see that fixed costs are inversely proportional to activity. The cost itself remains the same, but production levels may change. So looking back at our income statement here, rent would be a fixed cost. Labor could be variable or fixed, depending on if it's wages or a salary. Wages would be probably variable, right? The more people work, the more their hourly wages are. But if it was salaries, that would probably be considered a fixed cost. Right? So it depends on who's working and how that labor cost varies with production levels. Supplies would probably be variable, right? Because the more units that are produced, the more supplies you need. So that would probably be a variable cost. Depreciation, it's fixed for the year. This was straight line depreciation. So depreciation is the same, $2,000 per year. So it is fixed in nature and doesn't change over that as that asset is being depreciated. Let's look at this now on a little graph, if you like to look at graphs. Variable costs change in total as production levels go up, right? From 1,000, 2,000, 3,000, 4,000. Total cost also goes up, right? So if you have 100 units produced, maybe the cost is $100, $1 each. If production goes up to 200 units, then cost goes up, right? Total variable cost increases as production increases. Fixed costs, on the other hand, stay flat for a period of time. So if this is total cost and this is production, fixed costs stay the same no matter what happens with production. All right, and that's a nice little introduction to the cost behaviors of fixed and variable costs.